Hello, hello, hello. What's going on, everybody? Welcome to a capital hungry market analysis and trade ideas webinar. We are just going to be continuing from our previous market analysis webinar, where we have analysis active and playing out, but not the best market conditions for manual execution. What do I mean by that? Well, for example, just looking at the screen right now and looking at gold, you can see that for the start of the week, we anticipated some price setups where if we broke below this last rejection point and low, as well as 1972s, we could easily see some deeper pullback phases going into the 1960s and 1965s before starting to see buyers come back into the market. You can see we had step one take place with the deeper pullback phase, but we were just shy of retesting 1965s, having a couple of wick rejections there, and obviously did not get to retest into that demand zone at the 1960s. So we followed the analysis and still ended up having a bounce, but didn't get the best execution points of actually holding or getting confirms at 65 or the deeper retest to 1960s. We can see this evident in terms of dollar movement as well. Overall, since the last FOMC and into the month of November, we've had stacking fundamental catalysts for more dollar bears. But the price action to open up the week so far has been relatively choppy. We did show signs of digging a little bit lower towards the end of the North American trading session, but still ended up having the daily candle close back above the previous lows. And overall, even though dollar moved slightly down a little bit more through the session, it was still very choppy movement with quite aggressive lower time frame sporadic price action here. But we did have a 20-year treasury, 20-year bond treasury auction that held a little bit more weight towards the end of the day, which was unexpected, bringing a bit more dollar bears, a bit more bullish support for gold as well as the US stock market as the volatility index sunk lower. So price action was a little bit choppier today. You can see the indecision that occurred on Euro USD with spiking up and down and just starting to reject into the next intraday zone. We can see the indecision that occurred on GBP USD since the new weekly candle has opened. But we're still sticking to the same bias of playing dollar bears and that rate pause and rate cut narrative holding the most weight. The hopes of a Fed pause and earlier rate cuts in 2024 due to the stacking fundamental catalyst stated in the last couple of webinars. Just to repeat myself, the dovish undertoned FOMC, the weaker US jobs data, the lower than expected CPI report, the declining in retail sales and industrial production, that's still holding weight. We just, in terms of volume and volatility, didn't get the best execution points. For the example of Euro USD, we were going to be looking for safer buys if we could break above the previous intraday highs, but didn't get that much market movement above the previous intraday highs to close off the day. Or in the example of gold, as already stated, we didn't get the best manual confirmations of entries at 65s, or of course the deeper pullbacks to 1960. We are still respecting our analysis, but not showing the cleanest price action. Now, because we have lower volume and volatility, that shows me that we could still retest into these areas no problem. In the example of gold, don't mind this subjective trend line. This trend line was just to highlight some of the corrective structure and pullback from these highs holding the most weight. But gold could easily sweep into these areas again before still continuing bullish back into the deeper 1980s and 1990s. Overall, we're still maintaining that solid bullish sequence of events on the higher time frame here, as we had this overall more bullish impulsive rally due to the Middle Eastern tensions, about a 50% correction, and have broken well above that corrective structure where, in my eyes, as long as we're holding above the general 1960s here, Gold on the intraday time frames is still very bullish. Whether we sweep into this area again to create a more refined double bottom, or just have a short-lived pullback before still digging into the general 1990s and low 2000s there, right? So still continuing from our last market analysis, we still have dollar weakness and dollar bearish bias in play, just not seeing any major volume and volatility. We're still seeing that greed and optimism within global equity markets, with the US 30 breaking out a little bit higher towards the end of the day due to that 20-year bond auction having very good results with it, still fueling demand within the stock market and seeing yields turn bearish towards the end of the day here, like you can see here with the purple line. And the same bias and sentiment still in play. We just want to be adapting to current price points of interest, market sentiment, and just look at what events we have on the schedule before we do a deep dive into the analysis and trade ideas on these individual pairs. Oh yeah, sorry, and GJ. GJ's followed the first part of our analysis where we expected a pullback phase where we were going to be looking for double bottom rejections at 185.5, but we also anticipated, as it's still early into the new week, as well as we identified this major demand zone here into 184.8, where we saw an accumulation phase occur here before extending into these higher highs. We also anticipated that we could easily see deeper downside bearish moves into this area before seeing more buyers come into the market. GJ still respecting intraday bullish structure, still respecting higher time frame bullish structure, and still respecting this technical demand zone that we could easily retest into again and still be maintaining buyers in control like we were talking about during the New York session today. Now, before we jump into the individual technical analysis and analysis of key price points and trade ideas, we just want to see what's on the schedule for the coming sessions. Keep in mind, it's overall still expected to be a slow and steady week. We don't really have any major important economic events. And so far, in terms of looking at headlines for reactive events, it's been relatively quiet. So nothing going on through the Asian session today, but we're still going to be doing a Asian Zoom session around 8:30 p.m. Eastern, where we can answer questions, backtest charts, talk about 1-minute price action and technicals, still give out some trade ideas and scalping ideas through the Asian sessions if we have the volume for it to play out, but still put in some work through the hours there. But in terms of economic events, nothing really going on through the Asian session hours. London and Euro sessions also looking very quiet with nothing going on. And then through our North American trading session, we just have Canada CPI data and then US existing home sales data at 10. With the CAD CPI, as financial conditions have been tight, energy costs have been cooling, we can see a similar result with the US CPI, and we can see the CAD inflation dropping lower than forecast, and more than likely probably being right around prior. That can still lead to the Canadian dollar being weaker short term, showing the Bank of Canada doesn't need to be as aggressive with interest any further rate hikes or holding rates up for a longer period of time, which is translated as a dovish sentiment and more of a bearish impact on the Canadian dollar. So that's something we just had to look out for during our New York Zoom. But even that, it's not so important. I'm just breaking it down because we have it in focus tomorrow. It's not really going to be impacting gold or the US equities or US dollar that much, just the Canadian dollar when we specifically look at USD CAD, which in my opinion, even though dollar's a bit more bearish right now, the Canadian dollar is also very bearish. So UCAD can still remain in this higher time frame bullish range. Then we have some existing home sales, which is already predicted to show a slight decline from prior, especially as interest rates have been higher for an extended period of time. So that's naturally going to be cooling down the demand for home purchasing, right? Especially as policy lag effects are becoming more apparent and we're starting to see signs of cooling in the labor market, starting to see more struggle for the consumer and general worker when we're looking at the United States. So it's already expected to be a bit lower. I can see it coming out even lower than forecast. It shouldn't hold major impact. Home sales isn't that important just because it's already expected to be in more of a macro bearish trend due to the higher interest rate environment. But if it comes out closer to the minimum expectations below forecast, it can still keep dollar more bearish. It can still keep gold more bullish at these higher prices. Other than that, nothing important going on with the auctions or anything else in terms of pre-planned economic data. From a central banking and political perspective, let's just take a look here. What about the Fed business report? I don't see anything tomorrow unless it's considered a low impact report. This one, so we have a Fed business survey, but in terms of Reuters icon here, it's considered a very low impact report. It's something we'll note during our New York Zoom tomorrow, but it's not really classified as high impact data unless there's a major change with it. This national activity index, for me personally, I don't even acknowledge low impact reports. You can see when I highlight low impact reports, there's going to be a bunch of smaller, more minuscule data that's not as important. I primarily look at medium impact and then higher market impact. But anyways, from a central banking and political perspective, we do have a couple of ECB speakers scattered out throughout the North American trading session. We do have a couple of Bank of England speakers. And then we have the FOMC meeting minutes at 2 p.m. Eastern. Remember, this is not the actual FOMC rate decision. It's meeting minutes. Meeting minutes, no matter what central bank is reporting it, is a simple summary report of the last rate decision. Meeting minutes only holds any market weight if there's been any revisions, updates, or changes. I'm not saying there isn't going to be, but more times than not, there isn't any updates, revisions, or changes, especially when we're looking at the last few FOMCs, which have already been very monotone, copy and pasted FOMCs with nothing new brought to the table anyways. So something to look out for is meeting minutes, but I highly doubt it's going to be bringing any major impact unless there's some changes or revisions. It's probably just going to be the same copy and pasted FOMC statement we read and we did a webinar on. We do webinars on all of them, right? So that's it in terms of economic events, central bank and political events. Middle Eastern tensions are still quiet. They're lingering, but they're not holding any market weight. We haven't seen any major de-escalations of ceasefires or agreements being made to release more hostages that can lead to gold bears. We haven't seen any major escalations of other Islamic countries getting involved, or the violence starting to escalate, or further geopolitical escalations with other countries that can lead to gold bulls. So Middle Eastern tensions have been put more on the back burner in terms of market focus. Nothing new being brought to the table. All of the reactive headlines regarding Middle Eastern tensions are noise. Now, somebody messaged me because they got offended that I was saying the Middle Eastern headlines are noise. Remember, Capital Hungry is a financial market research group. When I'm saying the Middle Eastern tensions are noise, I do not mean to personally offend anyone saying that these headlines of X amount of Palestinians being killed is not valuable or not worth anything. I'm always talking about from a market impact perspective. Obviously, the Middle Eastern tensions are still actively going on. There's still terrible war crimes going on, terrible violence, extremely inhumane. I know that there's people in Capital Hungry that have a personal attachment to this conflict, whether it's religious-based, family-based, culture-based, whatever it may be. I mean no disrespect to you, Nothing I'm saying is from a social perspective. Whenever I'm saying that a headline is noise, I'm simply stating that it's no longer holding market impact. As cruel and corrupt it may be, even though the Middle Eastern tensions are actively going on in the real world, the financial markets don't care about it anymore. The majority of the information of it has been priced in. We saw that with this gold move peaked into the 2000s. Now, ever since gold peaked into the 2000s, through this time in blue, the Middle Eastern tensions have been still going on. But we know that the markets move ahead of the curve based on anticipation to have an edge. And they've already priced in the premium or majority portion of what the Middle Eastern tensions of what risks the Middle Eastern tensions were bringing to the table, right? Does that make sense to everybody? Everybody following along? Some new members who aren't going through the educational webinars may be getting confused by that. They're thinking I'm just being some asshole saying like, oh, these Middle Eastern tensions are just noise. Like, they're like, who cares about the war? Who cares about these people dying? It's not that. I'm just always talking about from a market impact perspective. You know what I mean? So far, from a market impact perspective, we haven't seen any new events that are either de-escalation points or escalation points. We're seeing that the tensions are still lingering. And so far, the market impact of it has been priced in. It's not holding major impact on gold, dollar, yen, equities, or anything right now, right? Hence, even though the Middle Eastern tensions are actively going on and thousands of people are still dying and suffering, oil's corrected all the way back down to $70 a barrel. If there were still active escalations of the Middle Eastern tensions, like Iran getting involved, US sending more boots on the ground, other NATO countries from the West supporting Israel on a physical front, increasing the violence, oil would be at $100 a barrel, gold would be above 2000s, right? But we care about what the market focuses on. The market's always looking for the next thing, forward looking, trying to gain an edge, trying to be ahead of the curve. That's exactly where the whole pricing in concept comes from. That's exactly where that old Wall Street saying, buy the rumor, sell the actual news comes from. Right? It's just that human factor of greed, and that's how these algos translate that order flow. But anyways, so leading into that, you may be asking, well, gee, if the Middle Eastern tensions have been priced in, I can see oil's corrected back to normal prices, but why hasn't gold completely corrected the upside? Why is gold still sitting above some of these key prices, still lingering in the deep 1900s, low 2000s? Remember, gold has had more fundamental factors than just the Middle Eastern tensions to keep it bullish. Declining US economic data, dovish undertoned FOMC, weaker jobs report, lower than expected inflation, pushing the rate cut narrative, declining retail sales or industrial production, declining PMI figures. Outside of the Middle Eastern tensions, this weakening of US economic data and feeding into the rate cut narrative also just happens to be more bullish for gold. Hence, I'm not expecting us to be surging up into the 2050s, but I'm not expecting us to be seeing a bearish correction of this downside move either. I can see us just playing above the 1960s to the 2000s for an extended period of days and weeks to come. Does that make sense to everybody? Everybody following along so far? Right? So now, anyways, analysis-wise, now with gold, I'm still macro higher time frame bullish on gold and can see us still digging into these general high prices into the low 2000s. We could even still dig into like the 2020s and 2030s before showing more signs of exhaustion. We still have the general more impulsive move intact. That's still, even though it's from the Middle Eastern tensions, is still being supported of gold remaining at these higher prices due to those other fundamental reasons stated: weakening US job market, hopes of earlier rate cuts, all of that being a lot more bullish for gold, you can see we're still holding above these last previous intraday highs and some of these key prices to the left. This still being a general 50% correction of the overall bullish rally, and coming back above that key price sensitivity area and zone above the 1960s. Outside of the key levels, if I was to identify some key interest points on the intraday, the three main ones would be 1940, 1960, and the low 2000 here, right? So that means if we double bottom here or still fail to break 1960s, we could still easily be digging into the higher 1990s and 2000s before seeing any major signs of exhaustion, rejection, or sellers coming into the market. That also means I can't even see any type of deeper pullback phase unless we're trading well below 1960, which I would still expect to be a short-term bearish move to the 1940s before continuing higher, right? Now, at any moment, as interest rates are higher, financial conditions are tighter, we're going to see more weakening economic data. We can have other fear, uncertainty, and doubt catalysts come into play outside of the Middle Eastern tensions. Something I'm still keeping a lookout for is more banking sector or financial fund failures. A lot of institutions and funds that were over leveraged on bets that primarily are only prosperous in a rate cut environment and lower interest rate environment, feeling the heat and feeling the losses in a higher interest rate environment. That's exactly what happened to the Silicon Valley Bank and exactly what pretty much happened to Credit Suisse in the Eurozone as well. In my opinion, a lot more cracks in the financial markets and economies are going to be exposed going into 2024. So we still have these Middle Eastern tensions lingering, which does not have a full solution for it yet or full optimism and can still potentially pop off. There's a potential for other geopolitical tensions still sitting on the back burner and sidelines, like the tensions we're seeing with North Korea poking some of the Western countries, Taiwan and China obviously still being in focus there. And overall, I'm still expecting US economic data from a macro standpoint to be seeing some more consistent declines, which can still keep gold's safe haven demand higher at these general prices. So now, main areas of interest that I'm looking at is, of course, 1940s generally, 1960s generally, and roughly into the high 1990s, low 2000s. These are the main areas. We can see that we broke out of this corrective structure, starting to show more buyers in control. We're still respecting where we've seen order flow generally accumulated in this area at 1965s. Now, either we can still sweep this area and double bottom for the buys, or just start breaking above some of these candle bodies and noise here before starting to dig into these same highs into the higher 1980s and 1990s, in my opinion. So when I'm coming to look at gold here, I'd be looking for these general buy plays still. Which still looks pretty evident. I'm a bit disappointed. I would have loved to see that downside dig deeper to the 60s or give better confirmations at 65, but it's okay. At least we've seen that even when we're zooming out and looking at the daily time frame to start out the new week, the daily made a pretty significant lower wick, but still closed with a minuscule body, much larger wick versus the body, didn't cancel out this bullish sequence of events, didn't cancel out the bullish engulfing candle. To me, the move we saw is still looking like the new weekly a price setup, just accumulating buy orders from lower prices before still digging into these general highs into the 1990s and 2000s, especially if we remain above the 1960s on the intraday. Does that make sense to everybody? Also, if we can show just a little bit more life coming out of this corrective structure, which is really just trading back above 81s, that's also just fair game for continuations if we don't get the pullback plays to set up our lower demand zones we were eyeing there, which was just a bit shy to start this week. And for anybody who's wondering, if we come into these 1990s and 2000s again and fail to break, just because we have low volume and volatility, you could still see higher risk, higher reward sells in the area if we're coming up to here in just general normal order flow and don't have any new fear, uncertainty, or doubt. Okay. Now with dollar pairs, ever since the end of the last month and going into November, we've been playing more of the bears. One, from a technical standpoint, seeing that we could not print any new higher highs, and it looked like we were just setting up order flow into the new business month there. Two, from the dovish undertoned FOMC, then from the NFP data, CPI data, and weaker data from last week. Now, it doesn't really show any signs of exhaustion just yet. For me to see signs of exhaustion, we would need to be failing to print any new lows, which was a bit of a tricky one today. We sort of printed a new low, but ended up closing back above. And I would also need to be coming above 103.6 key level in these candle body rejections. Failing to print any new lows and coming above here shows me the potential for a short-term corrective phase, secondary phase of market structure to retest better sell zones before continuing bearish. Where if we fail to break new lows and come above 103.6, that's going to be short-term bulls in control in the dollar, which can lead to a bearish pullback on GBPUSD and EURUSD. Otherwise, if we don't have the failure to break the lows or the combination of coming back above key level, then amidst lower volume and volatility, we can still keep chugging away bears in control all the way to the next interest point of the 103s. Right? Now, this gives me some pretty clean trade ideas when we're looking at GBPUSD and EURUSD using those intermarket correlations alongside the volume and volatility conditions. In the example of EURUSD, if we're just going to be continuing dollar bears to be printing some new lows, continue the bulls at least to the next key level, which is still another 30 to 50 pips, depending where we peak out here. Otherwise, what we can still anticipate is if we start to show more signs of exhaustion at these highs, break back below the key level, getting a pullback phase to retest the top of this accumulation zone where we previously broke above, at least to 1.087 or 1.084 before continuing the bullish trend seems quite evident. Now, when we're looking at the exact reaction points, we would really need to be trading below this yellow line here. Trading below this yellow line here lines up with dollar failing to print new lows, coming back above that 103.6 price, showing more signs of exhaustion by sellers on EURUSD, and at least some type of pullback phase taking place. First area of interest for the sells to exit or jumping into the better buys is at least around these previous highs, hugging the 1.087 key level Second area of interest is where we saw the buy orders accumulate before extending into these higher highs, which is 1.084. So I have one sell interest point, two buy interest areas with pretty favorable ranges to be playing in between. And the third buy is just simply if dollar keeps printing new lows, don't fight the current trend, no signs of pullback or correction, continue to squeeze up, which is another nice 40 to 50 pip range into the 1.0985s. Euro USD is still a lot more bullish in terms of price action and market structure ever since the start of November for the same fundamental reason stated on why the dollar is bearish. Right? Now, keep in mind, we don't have any major economic events in play. A lot of the major important data has passed and priced in. We have a US holiday weirdly timed in the middle of the week that changes the Friday market hours as well, right? So be more selective with your trades. Don't be looking to scale in as many positions. Don't be looking to use as aggressive lots compared to some of the days like CPI or NFP days where we take advantage of the data result once the dust and noise settles, right? Even if we see this correction, it'll probably be slow and steady. The buys probably won't be as impulsive either. We can see that with not seeing major volume to start out this week and with what we're forecasting with the events for the rest of the week. So if dollar fails to print any new lows, comes back above 103.65, that shows me the majority of the events from the previous week have been priced in. Sellers are exhausting from a new low being printed, and we can see some type of pullback phase in the example here, or in the example here, or like in the example here even, right? That combination of events of dollar failing to print new lows, showing more signs of sellers exhaustion and sellers exiting positions, buy orders being collected to provide that exit relief from an algorithmic perspective, leads to us seeing technical candles printing above here and starting to see a pullback phase take place, right? Which then would translate into quite easy confirms of a pullback phase a bit below the key level here. That's the one thing we just got to be cautious with this current dollar bearish run is where we start to identify some signs of exhaustion. You can see the same thing generally here. We're not printing new lows and coming above the candle bodies. You can see the same thing generally here. Something we just got to look out for here. Sometimes the pullback phase can be a lot larger in relation to the downside move. Sometimes it can be generally smaller. But during that period of time when the pullback phase is taking place, you want to adapt to that shift in market structure and being in a different phase of market structure there. Does that make sense to everybody? Everybody following along? Right? So just another quick simple summary. If dollar prints some new lows, technical breaks above here, continue this little bullish chug, which even with this bullish chug, it'd probably be continuing to go up like this, just because we have lower volume and volatility. You know what I mean? Where I'd see it peak out to around 1.099, the same time dollar may bottom out at our next area of interest in liquidity zone at around 103 flat, right? So if dollar just continues to break these lows, it looks pretty smooth sailing to go down to 103, which on like Euro USD looks pretty smooth sailing to the next key level. On GBP USD looks pretty smooth sailing also to the next key level, 30, 40 pips, even to this gray zone. But if we don't have that, we're noticing a secondary phase of market structure taking place, which is a two-step process. One, failing to print any new lower lows. 2, breaking above a minor technical resistance that can be identified. 3, the pullback phase taking place. That's when we can anticipate Euro USD and GBP USD giving us a little bit of a correction. Right? Does that make sense to everybody? Now, that's going to be a similar setup on GU. GU, we're seeing the exact rejections around key level, breaking a little bit above here. We could still be seeing a squeeze up into the 1.254s or 257s before starting to notice exhaustion. Otherwise, if we can break back below 1.248, I'm expecting a bearish correction first. Which can dig into the key level just roughly around where we saw the order flow accumulate here before. What do I mean by that? Well, when we had this high printed at the key level, we had a secondary phase of market structure, aka a pullback phase, night and day difference versus the impulsive movement of price anatomy, where we essentially bottomed out around 1.237, just shy of the 236 key level, before seeing enough volume to revisit these highs. If we fail to print highs and see some short-term dollar strength in a pullback, we're probably at least going to be going to that same demand zone and price sensitivity area again before anticipating any buys in the market. Otherwise, if we don't cancel out this upside move, dollar doesn't show a pullback phase, we could still just be chugging away into the 1.256s before seeing any exhaustion signs. The same time dollar goes to 103. I'm still in more of that dollar bearish bias due to the fundamental reasons stated. Our predictions and research has been on point. We predicted the dovish FOMC and the sells from 107s. We predicted the pullback to retest this range and the breakout with NFP. We predicted the CPI downside move. The only thing is we are day traders and scalpers. We can't just, even though dollar may be bearish in overall structure right now and overall going down in price and value, we can't just blindly play dollar bears every single session or every single day. Timing matters, right? For example, dollar overall here, right, has gone down about 3.5% over the last about 20 days through the entire month of November, start of November, 20 days. But some of these pullback phases can be dozens of pips in size. And for example, this pullback before we saw the impulsive move take place is 7 days. That means if as a retail trader who's scalping and day trading, if you came to the charts during the 7 days and were primarily just looking for dollar bears, you would still probably be losing, right? This one doesn't seem as large, but still a similar idea. Before we continue the bearish impulsive move, we had this accumulation, a bit of a correction for 2 days. That's just something we have to be mindful of. If we see dollar failing to print any new lows, if we see us coming back above the key level, as we have less volume and volatility, no economic events in play, getting a pullback phase that lasts a couple of days, even coming to the same accumulation area, would not be out of the ordinary at all. You know what I mean? Even going through the holiday, slower holiday Thanksgiving period, setting up prices into next week, where next week we have weaker US data and we continue the bears again. I would not be surprised by that movement at all. Does that make sense to everybody? So these market waves, they're important for us because we're not investing in the dollar or shorting it for the next 3 months. We're not looking to invest in these asset classes and hold them for years. These daily changes in price, these intraday waves, they're important for what we trade and the time frames we trade and the ranges we trade. Right? So even though I'm in a dollar bearish bias, and clearly it's been right, these periods still matter to me. They're still going to correlate to potential deeper gold price setups, or Euro USD corrections, or GBP USD corrections, or tell me a lot about what's going on in the equities and stock market. Does that make sense to everybody? Everybody following along? Right? So now that's just the critical point here. And the way I would assess, again, one more time, if dollar's going to see a pullback phase, is no more new lows being printed and coming back above 103.6. If we have those confirms, higher probability we're going to see a corrective phase in the dollar. If we don't get those confirms, I still see us slowly chugging away to the 103s. Now with USD CAD, it's a bit of a different situation. Both the US dollar and Canadian dollar are weak. Canadian dollar is weak from a slow and steady Bank of Canada approach. And when you're looking at the commodities correlation to crude oil as one of Canada's major revenue sources, the highest revenue source is obviously the exportation of oil, right, from the Alberta oil sands there. Because Canadian data has been weaker, Bank of Canada has been taking a slow and steady approach. Oil's back to $70 a barrel and corrected a lot of that upside movement. The Canadian dollar has been significantly weak. So yeah, we've seen some pretty aggressive bearish waves here on USD CAD, but nothing really highlighting the dollar weakness, US dollar weakness, because of how weak the Canadian dollar is. Tomorrow we have CAD CPI. I can see CAD CPI still being lower, signaling a slower and steadier approach by the Bank of Canada, still leading to some CAD weakness. We may liquidity grab into here, but in my opinion, UCAD can still just be digging into these general range highs into the 1.38s in this sporadic fashion. We're still respecting general bullish structure. We're still having buyers print these higher highs. We still have very bearish oil at the moment, just starting to find a support at $70 and a slow and steady approach by the Bank of Canada with expectations of inflation cooling. So I'm still looking for the high risk, high reward sweep 365 buys, break above 3.7, or sorry, retest of 3.7, or break above 3.74. With US equities, you can see we've been playing the bullish rally quite well as we've anticipated the dovish undertoned FOMC, the declining jobs reports feeding into a rate cut narrative, the declining CPI report feeding into the rate cut narrative, outflow out of the dollar and VIX very flat. But now we're coming to the previous all-time highs. Just with simple price positioning, I would be looking for signs of exhaustion at these highs. We're still maintaining structure. We could still squeeze into there, but into the 35,400s, 35,500s, just from a technical standpoint, as we're still amidst a higher rate environment, we still don't have full reasoning for optimistic greed and equities to be surging into all-time highs, in my opinion. I could be 100% wrong, and we've done a fantastic job calling the buys from 33K up, but this is a major, major area where I am going to be looking into these general highs for rejection. Outside of this general area where you can see the reaction points highlighted, the next major point is literally the last all-time highs at the 36,800. But I'm going to be starting to look for shorts into the 35,500s, 35,400s. So I see short-term squeezes still up into there, but starting to look for sells high risk, high rewards shorts, big shorts at 35,500, 35,400. Above 34,900 is still bullish into there. 35,100 still bullish. Break above current rejection point, but I am going to start to look for major exhaustion signs, high risk, high reward, bearish sell positions into that previous supply zone, an important price point where we saw a major sell-off before into roughly 35,400, 35,500. Last but not least is GJ. GJ, we're still in beautiful bullish structure, especially as we broke above these previous significant highs. So GJ still has buyers generally printing higher highs and continuing the trend. Last week, we saw a bit of a deeper corrective phase that's still being respected. Where we saw buy orders accumulate and collect before extending the upside move into these higher highs was generally into this accumulation zone here. We anticipated into this new week, we could come to the lows of this accumulation zone, a very key demand area, and still be maintaining buyers in control from more of a higher time frame perspective. When you're looking at GJ, it can retest demand zones multiple times while still maintaining structure. For example, even in the near term, look at this area when we were watching for buys during the banking sector during the Middle Eastern tensions when they were priced in at the 181s. Look at how many multiple hundreds of pips of movement you had. Look at this move that went to print a higher high, right? Still came into the same demand zone before continuing the trend. That's exactly what I still see here at the rough 184.8s, 185s. I can't be bearish on GJ any further at the current pricing unless we were to break below 184.5, which is then going into 183.5. So my main bias is still seeing potential moves like this. Secondary bias would be short-term sells adapted before seeing buys at 183.5. Japanese yen is still macro bearish with Bank of Japan sticking to their ultra loose policy. We still have the macro rate differential of a more hawkish Bank of England keeping interest rates in a restrictive territory versus Bank of Japan obviously just stated doing the opposite. The likelihood of a Japanese currency intervention has declined because dollar has naturally been more bearish over the last month thanks to the economic data results. So with dollar's upside volatility subdued, dollar being more bearish, that also decreases the odds of Japan's Ministry of Finance jumping in to prop up yen value, aka decreases the odds of seeing these types of currency intervention moves. So when I'm looking at GJ here, if we can sweep into this demand zone, I'd still be bullish. Breaking above current prices, 185.5, 185.8, I would still be bullish with three main buyer interest points. I'm only adapting to sells if my primary bias is wrong and we're trading below 184.5. All right, everybody. Keep in mind, market conditions still aren't the best due to the lack of economic events, no fundamentals in play, and obviously the anticipation of the more important US holiday this week. Major rate decisions have passed. Important events such as CPI, NFPs have passed until we see the next ones, obviously. The Fed pause and rate cut narrative still holding the most weight, seeing dollar more bearish, stock market more bullish for the time being. Even though stock market's more bullish and we've been playing the bulls very well, this is a major area of interest into 35,400. Dollar, the next area of interest is the 103s. And GJ, we're looking at that area of interest into the 184.8s. Be more selective with your trades. Don't overtrade. Don't over leverage. And don't be fighting the market this week.